Okay, I guess every time I unpush pause, the timer starts over. I'm hoping this is on one video though. Okay, so par value stock is first up to bat. The par value of a stock has no relationship to its fair value. The par value associated with most capital stock issuance is very low. In the early 1900s, they're saying practically all stock issued had a par value of $100. Now we have low par value stock because it helps companies avoid the contingent liability associated with stock sold below par. Corporations maintain accounts for each class of stock as follows. And so the two classes that they want to talk about are your capital stock and then the paid-in capital in excess of par. So under the category of the capital stock, there's two types of stocks that we study, which are preferred stock and common stock. So together, these two stock accounts reflect the par value of the corporation's issued shares. The company credits these accounts when it originally issues the shares because the stocks are they're equity account, so they would get credited and cash would be debited. So it makes no additional entries in these accounts unless it issues additional shares or retires them. The second type of account is, I'm sorry, my throat's getting dry. The paid-in capital in excess of par, also called additional paid-in capital. This account indicates any excess over par value paid in stockholders by stockholders in return for the shares that they are to receive. Once paid in, the excess over par becomes a part of the corporation's additional paid-in capital, and the bulk of the money that the corporations get are going to come in the paid-in capital in excess of par. The par values are really low. They're talking about 25 cents, and it even looks like they're talking about pennies. So that paid-in capital is the money that are really going to fund the operations of the corporation. So next, we're going to talk about no par stock. Many states allow for the issuance of capital stock without a par value, which is called no par. First, there's two reasons why. First, issuance of no par stock avoids the contingent liability that might occur if the corporation issued par value stocks at a discount. Second, there's some confusion in the relationship between par value and fair value, the fact that there is no relationship between par value and fair value. So, if shares have no par value, that issue goes away. One of the advantages of no par value stock is issuing stock for property items such as intangible or tangible fixed assets. I don't know why, but the book just says that. Okay, one of the disadvantages of no par value stocks is that some states levy a high tax on these issues. Other states may call the no par stock legal capital, which could reduce the flexibility in paying dividends. And I didn't really understand that either, but I may have some hints to it, but I'm not 100% sure. So anyway, unlike par value shares, corporations issue them without a premium or a discount. So with no par value stocks, there's just two entries. It's just whatever the market was willing to pay for it, you enter in only two accounts, which is the cash account and the whatever type of no par stock account. So the example here is If this electronic company issues 500 shares for cash at $10 per share, it makes the entry of cash debit $5,000, common stock no par value credit $5,000. So to illustrate how with no par stock you always only are using those two accounts, they say, well, okay, we're going to bump it up from $10 a share. Now the market will pay $11 a share. Again, cash debit $5,500, I should say. And then credit common stock no par value $5,500. So there's not going to be any additional paid in capital or discounts reported. Now, some states require a stated value, that no par stocks have a stated value, and the stated value is an amount that the corporation cannot sell that stock for less than. So that's pretty self-explanatory. So now when you do the entry with a stated value stock, if the stock sold in the marketplace for above the stated value, here's the kind of entry you would do. Now, instead of just those two accounts, you're going to bring back that paid in capital in excess of stated value instead of par value. So if we sold 1,000 shares of $5 stated value at $15 per share for cash, we're going to get cash of $15,000. That's the 1,000 times the $15. Then we're going to just put the stated value amount in common stock. So that's going to be the $1,000 times the $5 stated value. And then we're going to have to put paid in capital in excess of stated value common stock. That says dash common stock. Credit $10,000. So I said the common stock was a credit, right? So that's that.